Hey Emmett, this is Jeff Lockhart. I wanted to go ahead and do a second part since my initial presentation was a little bit longer than 10 minutes as a second thing that you can look at if you want to. But you can also look at this in conjunction with PowerPoint presentation under risks for investors, the last 3 pages before the bibliography. Starts out with there are various business practices on the part of Groupon that may first seem good for the merchants, however put potential investors at risk. This ultimately could result in Groupon losing favor with its investors and getting stuck without new capital options, which could be bad for issuing merchants in the long run. Answers are influenced from the articles referenced as number 3. Daily deal companies seem to be encouraging uncapped deals. Incentives for sales tend to be around the volume and dollar sales. Sales reps have disincentive to identify possible fraudulent merchants. No sale, no commission. Separate research departments are supposed to vet merchants, but they are often overwhelmed. Given that markets are valuing daily deal companies on revenues, there is also a disincentive for senior management to make an effort to fight fraud in the short term. Fraud actually shows up as revenue, which increases the value for the analysts until they have to offset it with losses. So far, consumers have been protected, even if a merchant disappears, refuses to provide services, or is simply overwhelmed. The big daily deal companies such as Groupon have covered those losses. That's great for the consumers. However, it creates risk for investors because returns can be significantly affected by fraud losses. In addition to the merchant's consumer and the deal provider, there's another important party involved, the payment system. Visa, MasterCard, and others closely monitor what they call chargebacks, transactions disputed by cardholders. If a company's chargebacks are high, they will require it to keep more money in reserve. If they're high enough, they'll stop letting the company take credit cards. Banks don't want to lose money if a merchant collapses. As far as the credit card companies are concerned, the deal companies are the merchant of record, so Groupon is looked upon as who's responsible for the credit card payment. Groupon has merchant liabilities of more than $291 million and an unknown amount of vouchers outstanding. Investors' risk continued. The current funding structure for Groupon shows current lack of investment by its key officers, as well as a recent exodus from the cashing out by existing investors. This ultimately can be a bad thing for the merchants doing business with Groupon if the company gets into financial problems. Answers are influenced from the articles referenced as 8. Groupon has total fundings of $1.14 billion, broken down as follows. Angel investing, $1 million. Series A, $4.8 million. Series B, $30 million. Series C, $135 million. And Series D, $950 million. Attributed, and then there's an unattributed $16.2 million. But the Series D is the issue I wanted to talk with you about. That was issued in January 2011, earlier this year. The Series D equity issue from Groupon, which just recently turned down a $6 billion acquisition offer from Google, which I think the guys were crazy, had raised $171 million as of December 28, 2010, much of it taken off the table by founders and execs. Expectations is that much of this new round of financing, if not all of it, will also be used to cash out existing investors. None of the various sources mentioned a remaining ownership or investment via key officers or even founder Andrew Mason. Therefore, those steering the ship are even less personally financially at risk than before the Series D issuance, which I believe means that the merchant is more at risk because then the investor has, then the people, the key figures here have less risk if they do have financial issues. But with this IPO filing now public, Groupon faces significant questions about the sustainability of its business model. A look at the company's overall financials shows a steep decline in how much money it is wringing from its fast-growing subscriber base. Answers to this are influenced from article referenced 9. By the way, the IPO has been filed. The filing announcement has been made, but the IPO hasn't gone on yet. And Groupon's income statement raises serious questions about the revenue recognition and GAAP confirmation. Specifically, Groupon is getting paid as a broker, where there is a sale, there is a commission. It's different from the traditional media, where fees are paid regardless of sales. Thus, it raised questions on two line items: revenues. First one is revenues. Groupon claimed 100% of the amount of the customer paid for a deal as revenues and split to merchants as its cost of goods sold. So it actually took on 100% of the revenues from a Groupon sale into its revenue cycle, and then the cost that they paid the merchant was shown as a cost of goods sold, which isn't how this GAAP says it should go. But it does not reflect the ownership and risk each party bears. Groupon is the broker here, not the wholesaler. Groupon takes no possessions of the goods and services, thus it can't claim 100% price if it charges the customer as its revenue. This is like a broker who assisted in selling stock for $10, and cost basis 9 claims 100% of the $10 as revenue, and then the $9.90 client's net as his cost of goods sold. Groupon's true cost of goods sold is the cost associated with the production of the deals, processing, etc. This is, I believe, is listed as marketing below the gross profit line. This should be above the line as part of cost of goods sold. This is the actual cost Groupon incurred regardless whether a deal sells or not. These financial statements are misleading in nature. It overstates its revenue by at least 50%. Its actual gross margin is not 40% as it claimed. It is almost zero. Of course, these percentages do not even include the SG&A. And that was published by Amanda from out of Seattle. I think she's a CPA who does reviews for the company that did this investor risk articles. So anyway, there you go. I just wanted to let you know. Hopefully you enjoyed this.